Good morning, traders. Today is Monday, the 6th of December. My name is Neville Hornsey, market analyst for YouTrading, and today I'll be taking a look at the week ahead. Okay, before we get into the economic calendars and data, we'll take a look at the Forex Heat Map. Currently, the bottom left-hand corner is looking green, top right-hand corner is turning more red. For me, that means it's more of a risk-on day for the commodity pairs and the Forex market as a whole. We can see that the yen and the Swiss franc, the usual safe havens, are actually red today. So the flows are coming out of the yen and safe haven and going into the likes of the Australian dollar. Why may that happen? Basically, it could be because the People's Bank of China, the PBOC, have told the banks that they can reduce their reserve rates or ratios, and that means that the banks are able to lend out more of that money, stimulate the economy. Australia and China are obviously closely tied, so that's good for Australia. It's good for the rest of the world. We might even see an uptick in economic activity, which means more oil, which is good for the Canadian dollar and such like. US dollars kind of mixed. The euro is turning more bearish. Today we had the German factory orders and that came in under expectations. So that's not good for Germany, it's not good for Europe. And we've obviously got the Omicron and Delta variants ripping through Britain and Europe. So at the moment, bullish the Antipodeans, bullish Canadian dollar, go long Aussie, short the yen. All right, looking at the British pound versus US dollar. Today, we've got the Bank of England MPC members, pretty much the only sort of tier one data out today. The Bank of England are actually unlikely to raise the rates because of the Omicron and Delta variant that is, worrying the government. The Bank of England are probably likely to sort of wait and see into next year to see, what the fallout was because of this variant, how well the vaccines are going to cope, if there's going to be some new mandates, or if the government are going to do extreme measures or not. Wait and see for British pound and the interest rate hike that is expected, just maybe not from this December meeting. All right, looking at the euro versus US dollar, it's basically in the middle of a range from 2014 to current. We had the lows in 2016, the highs in 2018, and we've been at this 1.13 level for quite a while. Tomorrow, we've got the ZEW economic sentiment for Germany and Europe. If we look at Wednesday, we've got ECB President Lagarde speaking, and then she speaks again on Friday. I don't expect to see anything hawkish out of those meetings. And traders will be looking to see how the ECB plan to extend the asset purchases, essentially. That's going to be the main focus. If we go to the Australian dollar, like I said, there's been a move into the Aussie, but we have been in this massive decline since the beginning of November, end of October. So we are in a downtrend. It's going to take a little while before we can get bullish on the Aussie versus US dollar. Tuesday, got the cash rate RBA rate statement, so that could be Aussie moving. I'm expecting them to be more bearish, more dovish. So getting this Aussie up back to sort of 0.71 is going to be pretty tricky, unless of course we get a big decline in the US dollar index and such like. But if we look to the US dollar and what affects that, obviously we've got the Fed. They use the interest rates to keep prices stable, and they also need to sort of create jobs. So last Friday we had NFP. Came in at 210,000, which was low and disappointing. They were hoping for good 500 to 600,000 jobs. They didn't get that. They did get an upward revision for October, so that's good. It pushes that towards the 550 that's required. But overall, the first 2 months of this fiscal year coming in at an average of 378,000. And if you look back to, all the way back to fiscal year 2016, 2017, 2018, 2019, they'd have been very happy with those sort of figures, from 210 to 546. Obviously, when COVID first came along, big move out of jobs, everyone became unemployed, unfortunately. So still haven't recovered from the fiscal year 2019, 2020. But 2021, the average was 484,000 over the year. So, if we can keep 2022 in the sort of 400s, around the 400,000s on average, I think the economy would be doing well. There is an expectation that the Fed will taper their asset purchases faster, and they will try and get these rates hikes going this year. If you look to the euro dollar, which is not the euro currency versus the US dollar currency, it's the euro dollar is the offshore shadow money, if you like. It's the dollars that are out in the world that aren't under the Fed's control. It's one of the deepest markets. It's also, highly linked towards LIBOR and the US 10-year interest rates. So you can see here that the interest rate expectations are for, steepening, so raising the rates. And then come 2024 to 2025, there's actually an inversion, which normally predicts a problem in the sort of overall markets. The economic sentiment will be worried about that sort of period. So after these initial rate hikes that the Fed are expected to do, we might be in for a bit of a problem before the markets return back to normality. So here we've got the US dollar index. It's trading in the range that was printed on the end of November. So the 30th of November here, big expansion of the range. And so far the last 3 days that had finished, all traded within, and today's also trading within that range. So it's looking bearish. Normally you get like a big pullback and then a little bit of a bounce, and then continuation to the downside. There is a double bottom here at $95.50. So I'm thinking that there's going to be a pull down to take that liquidity, and then obviously next sort of old resistance becomes support back down at $94.50. Wednesday, if you're trading the US equities, you need to watch out for the 10-year bond auction. And then again on the Thursday, the 30-year bond auction. That's going to affect the US dollar. It's going to affect a lot of things. But essentially, I've found that if you're trading US equities, you need to sort of wait for those auctions to finish before you get a clean move. We've got Bank of Canada rate statement on Wednesday, and then also their overnight rate expectations, which are expected to stay the same. Then the US JOLTS job openings come in after that. So the US dollar versus CAD. Now, the dollar index has been rising. Dollar versus the CAD has been rising as well. So if you just look at that, obviously that's highly related to Brent and WTI as well. And you can see here that when Jerome Powell said that it was time to retire the word transitory, he said it essentially when energy prices, which are a massive element of the CPI, it's just been dropping since October. So if anything, this is showing that inflation could be transitory. And if we do get a break lower than the $65 per barrel on the Brent, I think we could be looking at lower prices, in which case this dollar CAD's going to go higher. Obviously, if CAD's going lower, dollar versus the CAD will go higher. So if we look to the weekly chart, then we've got this really big sort of support area here, which will become resistance, and that's back up at 1.3, so a good 200 pips higher. Unemployment claims on Thursday, we're hoping to see those keep reducing. It was good to see that the unemployment rate was reducing, when we had the jobs data out last Friday. Then on Friday, I've already mentioned ECB President Lagarde speaking, but then we get, this really important US CPI. Looking at the VIX, we can see that, the market's starting to get a bit more jittery. Friday came and it was spiked up to 31. I don't think we've seen that since the very beginning of the year. So if the VIX stays at these elevated levels, then we're going to sort of see the ranges expanding on the likes of the S&P 500. If we just look at the S&P 500, we had a big down move, broke this bullish structure, found the 50-day EMA as support, consolidated for a couple of days, broke down again on the 1st of December, consolidated, and it does look like it's going to come back down maybe to this market structure here at 4,453, or we could be on for a big move below that down to the 200 period moving average here, because we haven't visited that for, well, since June 2020. So, 200 period moving average, always a good target once we are in a sort of a bear market. I think we can say that momentum is to the upside, but it is definitely rolling over. The 20 and the 50 have, started to roll down. The 200 is going to flatten off. And, there is this period here between September 2021 to October 2021, which is, obviously had a lot of trading in, but under these swing lows, there's going to be some stops that will, provide the liquidity for another push higher if, the economic data sort of maintains in a bullish way. The FTSE did quite well. Friday ended up sort of flat, but today's started good. And then the DAX, after that factory data today, is looking red, ended red on Friday. If anything, the DAX and the S&P 500, if they were to sort of keep falling, break through these sort of support levels and consolidation periods, then that could drag the rest of the equities down. So something to watch out for there. TLT is breaking higher. So there is a move out of risky assets into more safe haven assets. So something else to watch for. If that continues up, we have obviously got balance area here where we had a lot of trading. Still, it's still a ways up to go. But then, if we get through that, then all these sort of swing highs here will be targeting the liquidity. So come Wednesday and Thursday, so the 10-year is on Wednesday, but 30-year, which will affect the TLT a lot more. Come that day, if there's a good auction, then we can sort of imagine that it's going to keep pushing this price higher. That's about it really for this week. Probably best to stay vigilant on the tier 1 data. Make sure you've got an economic calendar. Make sure you're looking at the Forex heat map. Make sure you're sort of trading in line with both sentiment and fundamentals. And if you can find a technical level to trade off, do that. All right, speak to you soon.